Hello, everyone. Today's Monday, August 29th. Today on the final bar, we will hit the market from three directions. Top-down macro, talking about the S&P continuing to push lower after Friday's dramatic sell-off. Choppy session for the most part. We'll look at the increase in the VIX as well. We'll talk about sector rotation, some of the defensive sectors doing just fine, with energy at the top of the list in terms of renewed strength, and individual stocks, including a couple key breakdowns to note. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and hot Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The technical toolkit is really designed to help us through these sorts of choppy, uncertain, frustrating markets because it's all based on the evidence that the markets provide back to us. You don't have to worry about what happens if this plays out, or if this plays out, what happens if this level is reached, or if this pattern emerges. By looking at the charts in a consistent, disciplined way, the charts will tell you when you need to take action. It's less trying to figure something out and then trying to gather evidence. That's the reverse to what you should be doing. So let's focus on the evidence together today. Let's talk a little bit more about what happened on Friday, particularly what it led into in terms of the price action today with the choppy environment. The S&P down about 0.2%, but it's all about what levels we're aiming for now that we are, I think, for now in a short-term downtrend. We'll get to the charts here in a few moments. They want to let you know about some of the guests we have coming up on StockCharts TV, particularly the final bar. Let's see, this week on on Thursday, we have Mike Shell from Shell Capital Management. On Tuesday, tomorrow, we have Joe Rabel from Rabel Stock Research. Then on Wednesday, Miss Schneider from Market Gauge. So three really good guests for you, and I'm excited to hear their take on things after the distribution that we've seen off of the 200-day moving average. What's next? I'll pose that question to all three of those guests this week. Also, we have an event coming up in about a month and a week called ChartCon. StockCharts.com/ChartCon is the place to get more information on this fantastic event. We haven't done a ChartCon in a couple of years since pre-pandemic. We're excited to bring it back for you. It is a 2-day virtual event, and we're bringing in a number of commentators to our main offices in Redmond, Washington, our brand new studio. We will be coming to you live from Redmond with some fantastic discussions about the market environment. I wanted to highlight today our two keynote speakers, Larry Williams and Linda Raschke. We featured Larry and Linda's perspectives on StockCharts TV for a number of years now. Larry, we've been very fortunate to host a series of special events. He's had his own show on StockCharts TV before. He has a special market update, I think, coming the week after next. He will be talking about how he approaches this sort of a market environment. This is a rare opportunity to hear from one of the masters in technical analysis and trading, sharing his expertise. Linda Raschke is one of those people that really earned her stripes on the floors in Chicago, still trades every day, and will share some of the tools that she is using to make sense of these markets now. This is a great opportunity to hear from two master traders and educators. Go to StockCharts.com/ChartCon. Sign up today. It's going to be a lot of fun. We'd love to have you be a part of it. Let's continue on today's show with our market recap. Let's talk about how these markets have evolved today, how that fits into the big picture. So when you think about equities, it was really about that distribution day on Friday. What a sell-off going into the weekend, after really during and right after the Powell press conference, really changing, I think, the character of this market. Now, many have been talking about the challenges for further upside, potential for further downside. However, I think this changes a lot because now you're actually seeing some follow through to the downside. It's less about what could happen and more actually what is happening right now. After a big sell-off on Friday, after you have a big move, I always talk about a follow-through day, right? Where do you get confirmation that wasn't just an aberration, just a one-time thing, right? Sometimes the market investors can get really excited, really nervous, really, optimistic, and a big move happens, but then that's it, right? Like that's sort of the end of that emotional reflection in the markets. Today, it was all about, I think, what's called the follow-through date. You see a little bit of further downside, and I think we got it, right? With the S&P down 2/3%, closing the day around 40.30. The NASDAQ composite down 1%, NASDAQ 100 as well. So the NASDAQ composite holding just above 12,000. All of this while volatility is increasing, right? The VIX continuing to push higher, well off of that 20 level, which we talked about. Pretty reasonable place for volatility to bottom. It did indeed, although it stayed there for a little while. We popped higher, and now we're seeing stocks sell off in concert with rising volatility. Let's look at some of these other asset classes very quickly, and then we'll come back to a couple of those charts and dig into them in a little more detail. Interest rates continue to push higher with 10-year yield above 3.1%, long bond yields around 3.25%. The dollar index really not too much change from Friday. So this is really about interest rates pushing higher. And if you look at the sectors that struggle today, it's really things that tend to struggle when rates are going up, to be honest with you. Commodity space mixed, to be honest with you. Energy doing just fine. Oil prices moving higher. The energy sector rallying very well. Gold and silver basically flat to a little bit down. So sort of a mixed day with the precious metal side of it struggling. A lot of green on the charts of cryptocurrencies. What was interesting is before, as the US equity markets are opening, you're actually seeing cryptocurrencies moving higher. So this is one of those weird, interesting days where there's a disconnection. A lot of times I feel like stocks and cryptos have been kind of moving together, sort of risk on, risk off reflected in both of those charts. This is one of those days where you're actually getting the opposite reading. Cryptocurrency is actually more of a risk on day, with Bitcoin back, testing 19,500 overnight, but then rallying and getting just back above 20,000 here as we're going live with the show after the equity close. Ether prices right around 1535. That's almost 8% above where we were over the weekend. Let's go back to a chart of the S&P 500, talk about these levels. And we spent a little bit of time on Friday, actually a good amount of time looking at this chart and thinking about the importance of some of these key levels. I find Fibonacci retracements to be an important way of just defining risk, right? Defining a line in the sand. I find a lot of technical analysis for me is about risk management, about money management, right? It's less about some, magical way that the charts can tell you an important level when something's going to turn. That's not how I think of this toolkit. I think of this toolkit as a way to clearly define your potential reward and clearly define your potential risk. And if something like Fibonacci retracements or moving averages or trend lines give you a level at which you agree you're going to revisit your position, I think there could be value there. And it's all about how you apply those in a disciplined way. For me, something like this is a perfect opportunity to apply Fibonacci retracements, because what that is designed to do is tell you when you have a big move, for example, mid-June to mid-August, we go from 3650 up to just about 4300 in about 8 weeks. Now we start to drop down a little bit. At what level might you expect levels of support? And by taking that framework, the low from mid-June, the high from mid-August, 38.2% of the way is 4060. That's almost to the penny where we closed on Friday. And that's why on Friday's show, we talked about, do we get follow through, right? We're trading down to that level. We closed at the lows. Clearly, this was a puke out Friday, limping into the weekend as we show weakness through the course of the day. Now what, right? Do investors have a weekend to kind of reset? Do we get a bounce off of that level? Not seeing that yet. Today, actually seeing further downside. And we'll get a little later to charts like PDD, Pinduoduo, I think is a great example of what happened today, with an open initial rally, right? An additional sort of bounce, but then gave all of that back by the end of the day and ended up trading more at the lows going into the close. Now that we've broken 4060, what do we do next? So the logical steps would be go through these key levels of support. Keep looking left on the chart. Where is there meaningful support or resistance? The 50-day moving average is right around 4,000. That's a big round number. That's also the 50-day moving average. I think we're really close to that. I mean, that's the next short-term level I'll be looking for. Given the fact that we broke that 38.2% retracement level, I'd be looking down to 3,900, which would be that next level of potential support. What happens when we get to that level? If we would get down to 3,900 here over the next week or two, that potentially sets up a very head and shoulders like pattern. Now, the problem with that pattern here is you would have to rally a lot to actually engage that head and shoulders bottoming pattern. This is kind of I think, a concern for the bullish take, using that as your justification. The rules, the way that you determine where do we go, if we would put in a higher low here, is you take the neckline, which would be early June to mid-August, you draw a trend line. That's going to be all the way up here, sort of like the 44 to 4,500 range. We'd have to get all the way up there to validate that head and shoulders bottom. So if you're looking that as a way to justify a long position, I don't think that on its own is going to do it for you. But using some of the other tools that we can take advantage of, things like PPOs and RSIs and all that, absolutely still important. I'd also be looking at the momentum, because in a bull market phase, the RSI tends to bottom out at 40. That's not too far below current levels. Just to finish off our market recap here, if we go to the intermarket charts, let's see, we can look at gold. I just wanted to talk about because it's not really participating. And I think it's important to reflect. I mean, I try to highlight charts that are moving, charts that are actionable, but I don't want to just ignore things because they're not actionable, they're not moving. Let's make sure we reflect on all of these different pieces of the puzzle. This is why my monthly chart review that I do for my Market Misbehavior Premium members focuses on each one of these charts every month so that we make sure we take a look at them, make sure we understand where the dynamics are shifting month to month. Gold's just still not there. And if you look at the chart of the GLD or $ gold, which is the gold commodity, you can see that the momentum just firmly negative. Until that changes, until you see a rally and the RSI gets above 60, I don't think it's anything that you could be too excited about just yet. Our next segment is sector setup. So we talked about the big picture, talked about the sell-off on Friday going into today, where we saw a bit of a further downside follow through. What can we tell from the markets about sector rotation? Let's start with the RRG. This is the relative rotation graph. If you're not familiar with this, we don't have time to explain too much of the mechanics, except that things tend to rotate in a clockwise direction as things rotate in and out of favor around a relative benchmark, which is going to be at the crosshairs. Julius DeKempener, one of our StockCharts contributors, designed this methodology. You can watch his show Sector Spotlight if you want to learn more about it. When I'm looking at the weekly RRG, I'm struck in a big way on how energy has now rotated north. Last week, when we looked at this chart, we talked about how potentially what you would want to see from energy, if you think that that's going to re-engage, is you'd want to see it rotate more to the northeast before it gets across the zero line, because what that tells you is the relative strength is still strong. It's just more of a cyclical, up and down swing within that string of outperformance, of long-term outperformance. So it's more of a short-term rotation within a long-term stretch of relative strength. And that is, I think, what we're seeing here, right? You're seeing the XLE rotate to a northeasterly direction that really paid out in the last week. I think that tells you that the energy sector is really, again, starting to reemerge. We're seeing that on the individual stock basis. If you look for stocks making new swing highs, it's a lot of charts in the energy sector right now. And it's not just one part, it's a lot of things. It's pipelines and E&P stocks and the integrateds and all of those different things. We'll look at a couple of those if we have time before the show is over. So that's one thing certainly to note. Also, the improvement in the utility sector. And when I look at charts, sectors with relative strength making or at or near a new 12-month relative high, utility is one of the few. We'll look at that chart here in a few moments. The XLK and the XLI, technology and industrials, the only two that are in the leading quadrant at this moment. The XLI has really been very, very close to the 0 point, which tells me it's not a great relative bench because it's not super differentiated from the benchmark. It sort of is the market, similar to real estate, kind of just moving in line with the market, nothing really exciting there. Technology is the only one in the leading quadrant and a little bit stronger, but now starting to rotate south a little bit. And I think that's an interesting rotation to see some of the value defensive stuff start to rotate up, see things like technology, watch XLY as well to see if they rotate to the downside. That could be the sign of that further move in the direction of defense over offense. Now let's look at the 11 S&P sectors using the candle glance function. Again, this is a great way to just take a group of anything, stocks, ETFs, put them on a pile, put them on the screen together and just see what's what. Now, I think I asked the same question last week, but I'll ask it to you again. When you look at these 12 charts, the 11 sectors and then the S&P in the lower right, which of these stand out as being different, right? A lot of these are looking very similar. We've obviously pulled back many of them off their 200-day moving average, just like the S&P 500 has done. Many of them sort of testing moving average support, testing the 50-day or breaking there. But what stands out as being different? And for me, two charts stand out, maybe three. First one would be energy, which is obviously the only one out of these 12 charts that is actually heading up in the last month, right? The rest of these, it's really more in the last couple of weeks, right? Since the market topped out in mid-August, the last 2 weeks, all of these have been pulling back. All of these made a new swing high, or many of them made a new swing high and now rotating downwards. save energy, which is the one that is actually continuing to push to the upside. I think it's really important to note when you have an outlier, energy, very much an outlier in the first 6 months of the year, that changed from mid-June to mid-August when the markets are bouncing, when a lot of growth sectors are bouncing and energy is just doing the complete opposite, pulling back and obviously underperforming during that 8-week period. But now look at the month of August, where it's actually making a rotation to the upside. Energy is very close to being overbought, while most sectors are nowhere near overbought conditions. That outlier scenario, that indication that something's different and something unique is happening with energy, that's what I think was the story, or one of the great stories in the first half of this year, certainly appearing to reemerge here. Compare what you see there with something like discretionary, right? Rotating up to the 200-day moving average, just like the S&P 500, pulling back off of that moving average. The XOY is at a really interesting point. And I love thinking about what I'd call a line in the sand, right? What's a level at which you agree you'd have to revisit a thesis? And let's assume you had perfect foresight and you bought in mid-June, right at the bottom, the closing low. You just went all in on the XOY and you're feeling like a rock star hero as it rides all the way up above its June highs and goes up to the 200-day moving average. Well, the question is, now what? Now that we've given back a lot of those gains, about a third, half of those gains, when you've pulled back to a key support level, this might be one of those times when you revisit whether a long position is still justified, right? The high in June breaking above there was monstrous, right? When we rallied up here, pulled back, and then broke to a new swing high. That was a great signal at the end of July. Now we're right back at that point. What would it tell you about the prospects for consumer discretionary if we get below 157 and get back below that breakout level? At what point, holding a long position, would you agree to revisit that bullish thesis? That is the exercise I hope you do on a chart of the XLY and any other of this charts, stocks, ETFs that you are holding in a portfolio. Make sure you define those exits so you know when you need to let go of a position that's not working. Let's take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining me every weekday after the close for our show. A couple quick announcements before we continue on with Shifting Stocks. First off, we welcome your questions. We had a great mailbag segment on Friday. A lot of really thoughtful questions from many of you. Keep them coming, and we'll answer more tomorrow on Tuesday's show. Our email is thefinalbar@StockCharts.com, and I would just encourage you to include a link to the chart that you're looking at on StockCharts if you could. That'll help me see a live version of what you're asking about. Makes it super easy. You can also ping us on Twitter at FinalBarSCTV or on our YouTube channel. Just put a comment below the video you're watching there. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform, available 24 hours a day, 7 days a week, with some amazing, thoughtful content from some really excellent contributors and expert guests. StockChartsTV.com is the place to go. Or on your mobile device, just search for StockCharts TV on demand. Let's continue on today's show with our third segment, Shifting Stocks. We've now completed, or we will complete, our three-pronged approach every Monday. We start big picture, talking about that sell-off on Friday from the equity markets, continue to push a little bit lower today. Then looking at sectors, we recognize the strength in places like energy and utilities, the two sectors out of the 11 that actually finished in the green today on Monday, the 29th. We're now talking about some individual names, and I want to start it with PDD. PDD was one that came up sort of a news-driven note today, and a nice gap higher. And what I was interested in on this name is you gapped higher on Friday, but traded lower, right? And that's never a great look to have a stock gap higher, clearly on some sort of news flow or some sort of, overnight something that is causing a change in valuation, right, from the end of one session to the open of the next. But instead of rallying from there, instead of gapping higher and pushing onward and upward, we're actually pulling back a little bit. If I change this and just look at the what we call the candle glance, that is not it. Hold on, candle focus. That's what I call that one. There we go. This is showing the last 2 months, as a candle chart, this is what happened on Friday's session, right? So Thursday, big move higher, getting above the 200-day moving average, big thumbs up. Friday, we open higher, but then just like the rest of the market, getting dragged down and pushing to the downside. Today, we gap higher again, and that's when it popped up on my radar. I'm like, what's actually up on a day when everything seems to be going lower? This hits the filter, but look at what happened through the course of the day. Earlier in the day, it was all the way up to 72. And I remember looking at this thinking, wow, talk about a stock that's actually up while the broader market is giving you the completely opposite signal. By the end of the day, it turns into what's called a shooting star candle. And if you can assume what that means based on the visual, it's not good. And what that means is you open higher, right? You open a little bit higher, you're in an uptrend. You trade much higher, but by the end of the day, you get back down to the lows. And it doesn't matter whether the open or close in higher. Either way, it's the same thing. The rule is you just need a long upper shadow and a limited little to no lower shadow. That means you open and close right around at the lower end of the day and you traded much higher. So it literally looks like a star shooting down from above. It's a negative candle telling you the next 1 to 3 bars most likely lower. So the fact that I'm getting charts like that as I'm seeing the major averages come off on Friday and then opportunities for leadership, right, for names to actually work, coming back down to earth by the close is not a good look overall. That's sort of a negative sign, I think, for the markets, but certainly for PDD as well. I think that upside might be limited while you have candles like that popping up. Wanted to highlight JB Hunt because the trucking companies actually have screened fairly well recently, particularly about a week or two ago when you see them getting above moving averages. A lot of things obviously making new 3-month highs. That's a screen I run every week. And I saw these names, JB Hunt and some of the others, getting above their resistance levels from June. Nice push to the upside, nice move above the 200-day, stalling out in this case around 195. Today, giving back even more after Friday's sell-off. So while the S&P is sort of giving back a little bit after Friday's sell-off, the trucking group was one of the worst industry groups out of our 106 that we have that we track as part of our sector industry system. Moving to the downside, now down to around 175. Can this hold its 50-day moving average? That would be the question at this point. Can the RSI stop going down because it's right at 40? It's just, literally right there, which means we could stop at the 50-day and bounce higher. The momentum holds 40 and rolls up, and this feels like kind of a reasonable pullback. However, we're not far off from getting below the 50-day, the RSI getting below 40, in which case this is a very different look. This has the look of a failed breakout with follow through to the downside, and I think that's a questionable sign for trucking companies. CRM is one of those technology stocks. NVIDIA is a very similar kind of feel. I'll bring that up here for a second. NVIDIA kind of topping off at 190, never really getting above the June high, now back below the 50-day and making a new swing low on Friday, following through today. Similar look from Salesforce.com, resistance around 190 in this case. That's what we hit in early June, hit it again in early August, now rotating back, testing the lows. Now, you could make the argument, is CRM a buy at 155 because that's where it's bottomed out before? I get the argument for that. That is not the way I play technical analysis because I have found that prices go down for a reason, and buying something because it's gone down a lot is never my favorite reason. Buying something that has gone down and then shows signs of accumulation, that is interesting to me. CRM and NVIDIA, coincidentally, really not showing that in any case. BMY is Bristol-Myers Squibb. We don't have time to go through a ton of stocks, but I just want to show a couple more here. BMY gapping lower today, and again, that's a concern for the chart for sure, because what this does is it takes it back below the 200-day moving average for the first time since really January, February of this year. It's back to January when you first broke above the 200-day moving average. This is a stock that actually performed beautifully in the first half of the year. It looked more like an energy stock, right, than anything else. Strong relative strength starting in December, continuing to move higher, though. From the last couple months, you've seen everything else, the growth stuff start to work while BMY struggling. Now this gap lower, really up pushing it down, putting in the oversold region, but that on its own is not a great sign for me. I think this shows a lot of weakness internally with that name and dangerous downside potential. Just to finish off here, let's look at a couple of the energy stocks while we have a few moments. Energy, as I mentioned in the sector setups segment, doing a really good job of showing relative strength and price strength, right? So you're seeing prices rotate higher. You're seeing tests of previous resistance and then moving to the upside. So while energy stocks struggled from mid-June really to late July, early August. You're now seeing a real improvement here. And that's despite the fact that crude oil prices really haven't moved to the upside as much, nearly as much as these energy stocks have. I like the look of a chart like Diamondback getting above, new swing highs, making higher lows, the RSI getting above 60, the relative strength improving. And you're seeing the same kind of look on something like DVM, which is actually testing all-time highs, Apache, like PXD, Pioneer. These are all charts that have a very similar look in terms of rotation to the upside. A lot of these names becoming overbought. It's, at some point that becomes an issue, and it usually suggests short-term weakness because it's moved so high so quickly. But given the fact that most things are nowhere near the overbought condition, that shows me what an outlier it is, and that investors are clearly rotating to the strength you're seeing in the energy sector. So some strong charts really improving on a day when most things are actually down. Final chart I'll show you. Netflix. This is a name and a chart probably familiar to many of you. Out of the 8 phenomena stocks that I have on my dashboard, this one was the best. It was actually positive, while most of them were down, and the tech ones especially, and down to Nvidia and Adobe, all sort of moving to the downside today with the rest of the growth trade. Netflix actually holding in there okay. Now it's an okay chart. I would describe it as okay, right? And it's pulling back, which is okay. It's holding the 50-day, it's holding 200. Charts like this, if it can hold those levels, it's not bad. The momentum is not negative yet. It's just coming out of an overbought condition. Can it hold 40 if we continue to move a little bit lower? I think there's room on a chart like Netflix to actually remain fairly constructive. But you have to remember, this is very much an outlier. I think a lot of these are now testing support. And again, very quickly through the course of this week, we can go from a dramatic pullback off of the 200-day moving average to something way more significant. Keep an eye on these key levels for key charts. We need to wrap the show, folks, and go right to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, the S&P 500, along with 2 breadth indicators that I love to follow. This chart is included in my Mindful Investor live chart list, which I keep updated on StockCharts.com. We have the percent of S&P members above their 200-day. I think what's so interesting about this chart is it never got above 50%. I've had this horizontal line on here for years, which tells me whether or not we're above or below 50%. It's like a very basic breadth indicator. Are most stocks above or below their 200-day? It's been below really since, February, March, April, kind of chopped right around that 50 level and then really went lower in May. That's something that really told me that there was internal weakness in the markets. With this rally, we didn't get above 50%. So while the S&P failed to regain its 200-day, most stocks actually struggled as well. You can see in terms of the stocks above their 50-day moving average, it went from above 90 all the way down to 60, which is where it ended the day today. So you're seeing a lot of weakness in this breadth indicator. About a third of the S&P was above its 50-day moving average a couple weeks ago, now back below. Watch for that to continue. And if you're looking for some line in the sand, some level at which you have to acknowledge that the trend is no longer higher and it's starting to get lower, I would be watching this 50% line. On the other hand, if it holds 50% and bounces, that could be one of the great short-term buy signals that we've seen. That's why this chart, I think, is so important to watch this week going into next. Chart number 2 is the XLY. In our segment sector setups, we talked about some of the individual sectors and what rotations we're seeing. The XLY really has not been a great chart, and on a relative basis is where it's been so challenging. But look on a price basis. The high from June was a great signal when we broke above there in late July. That gap above there was an exclamation point to this rally phase. We've now given all of that back, and we're right back to support around 157, 158. Look to see if that level holds. If it does, not a bad constructive, level of support, and could be saving this further distribution. We fail here, though, and I think that could be very negative. By the way, on an equal weighted basis, remember that this ratio never got above the June highs, which is actually a sell signal right there. Finally, Domino's Pizza. I've been listening to a podcast talking about Pizza Hut versus Domino's. I'm looking at the chart earlier today, trading below its swing low in July. Again, when you need to be concerned is when stocks are unable to break above previous swing highs, when they start breaking below moving averages and previous swing lows, and when the RSI gets below 40. That happened today for Domino's Pizza. Folks, that is our show for today. I want to thank you so much for watching us every weekday after the close. All of our previous shows at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.